We have so much to get through today. We had the biggest stock in the market just report a bang out earnings showing the AI trade's going to keep going. And we're going to give you our numbers on this stock. Then we're going to get into what should you be watching to know, is the market going to go up or down? And then finally, we're going to review what stock that we bought today. Right off the bat, let's get right into this, okay? Basically, Nvidia came out, surprise, surprise, completely up revenue 85% year over year. Their data center revenue up 92% year over year. And this company's out here trading at a 4P of less than 30. They announced a new share repurchase and a cash dividend from 0.1 to 0.25 per share. Just look at this income statement out here that this company has. This is just beautiful. A++, perfect income statement. Look at the margins that they have. 74.9% compared to last year was a 60.5% margin. Do you understand how crazy that is? And this company also has a $5 trillion market cap. To get those margins up that freaking much, that's just unbelievably unreal. And just this shows that the sheer demand there for the AI business and everything is just still there, with powerhouses like Nvidia are putting up huge gains right within this year. And what they did is then they went and they guided for higher revenue for this next year, making analysts raise their numbers. We're seeing just price targets today of Nvidia get up to like $91 a share. $500 a share. They're trading at 220. So price targets are going double up right now. We got them after this earnings. And a lot of what they have with all these new chips, and the best part they said that came out for them, and even good for AMD, is the total addressable market of the CPUs. Instead of Lisa Su said it was going to be 120, Jensen came out and said it was going to be 200 million. That's 80 billion more than Lisa Su said. And just let's take a step away from AMD, Nvidia here at the moment, right? What we're going to do is let's just go and look up our site for Gamma, our site and everything. You can go and just check out your stocks, say like, hey, look at your watches, see how the market, see how all these companies are going to come in. How big did Nvidia just come in and beat our earnings? You could have seen that here just on our site, right? And then the next super cool part where we like to go and you can project out our projections. Let's just go and look into AMD before we even get into any of these numbers for Nvidia out here, right? So say we think that their revenue growth is 47%. Because this is assuming 120 billion TAM, with AMD getting about 40%. So 40% round of 120 million. So say they're able to do 50 billion. Now say it goes up by 80 million more. That's another 30 billion revenue they're going to be able to do, possibly. So let's just say this let's just take this number up here to 50. No, this would be like, let's just say 195 to be safe, right? And to get that, what would margin do they have before I had them? So I did a 29% margin, 75. Then just to get up to that margin, they would have to be doing this crazy amount of, instead of, let's just say they just put them in here. So let's just do 98, 90, which honestly, 29, they would get up to closer to 30 because if there's more demand, then they have more pricing power. They can sell for more. Their net income's for more. So instead of just they're almost a $2,000 stock by 2029, if that actually holds true. And they can do that much revenue. Now, we want to just be conservative with that because what do we know about Jensen? He's always out here trying to go and push everything, pump everything up. But just understanding with AMD, like we have this stock going to $1,600. So like from right here, it's just literally almost like they're 4xing. If you get a stock that can run that much, you're getting unreal gains. Now let's just go and look here at our Nvidia numbers just to say like, hey, what can they do? What's our bull case? And I think everyone understands the thing with Nvidia is how long can they keep these numbers up? How long can they hold these margins? Because I'm just going to be the first person to tell you, those margins they're getting, they're not sustainable. With AMD starting to be on the heels, even though Nvidia is the giant right now, this is a few years, and if the build out slows or the capex slows, Nvidia is going to get hit the hardest. So just from a base case, we have them doing 75%, 40%, 25%, going down to 20. So this full year 30 is like the end of the year 29-ish almost. Or we're thinking the market is going to be about 800 billion for the data centers, not including CPUs. So, I mean, they can reasonably go and take like a pretty big, like 60-ish% share and just make some more money from other, and say the market just gets a little bigger is what we have. They can make money from other operations, like 10% of their money from others. So we think they can get it to around like 700, 800 billion in 2030, just going down their revenue growth year over year. And their net income growth actually gets worse also because their margins arguably might be compressing. Like you could honestly get like this like 23 and then like 18 here. Because what's going to happen over time is their margins are going to get worse and worse because you can't sustain all these margins here. And I mean, a 20 to 30 for them going at 2018 going down, like people aren't going to price them that crazy to the forward. So, I mean, we have them just realistically about doubling up over the next 4-ish years, which, I mean, that's good. But for a company that you're really taking a risk of, like, how much is this PE really going to get hit? How much is it going to go compile? And then we have them for our bear case, 70, 35, 20, 15, and then them just really getting down and not performing under this, like, because they can't keep the margins, they can't keep the pricing power, because maybe the revenue's up there, but their net income starts growing slower because they have to price it down almost, even though they're still making the same, or they have to like price so they're not making as much net income on the bottom line. And that's really, they'd only be trading at a 20, just going there. I mean, and they would make you a little bit of money, but it's nothing crazy. Like you're losing money here, 4.36%. You're literally better just being money within treasuries at that point. But then your bull case, you get a pretty good 80, 50, 30, 25, which maybe is just, it's leaning more. It's a pretty conservative bear case. But bull case, say they go back there, their margins somehow get better, get up to 61%. We keep the super cycle going. 50, 60, 45, 35, 45. They're getting up to 954. So they're almost a 5x from this point with their bull case, which if you're looking at other stocks like AMD, like we were telling you, we're like, okay, this stock is a 5 to 10x. For their base case. So that's why we just think the money's within AMD, because they're not relying on these 61% net income margins. They only need these net income margins of 30%. They don't have to do crazy or anything like AMD has to do. AMD just has to go, they have to do a thing, get up to 29%. Nvidia, they have a much harder time because they have to keep these crazy margins. Like look at stocks like MU. They have like 70, 80% net income margins. Nvidia doesn't even have that. Those are just unsustainable. And that's just the problem with some of these companies is they're going to get a lot of compression because whenever your margins get worse, your growth rates get worse, that's whenever you really get starting to hit hard. This is another piece of advice that you want to look at. This will come out Thursdays every single week, and it's such an important thing to look at because you got to see how are people in the market positioned. Because just think of all the crashes last April, right? It wasn't good what the tariffs and everything were going to do, but people were so bearishly positioned, no one was bullish. They were buying puts, they were selling everything. There's nobody else to go bearish. The market can only go bullish. Think about just a little bit ago. Let's look at the bearish high. Just about the bottom of the March lows, right? That's what happens. Whenever people start getting so bearish about the market, that's whenever you're like, okay, I need to be buying because I'm getting great deals and nobody's buying and they're just selling stocks. And the thing is, we're humans. They're so short-sighted. They're going to act irrationally, even though the fundamentals haven't fully changed yet. And even if they're going to change, they're going to sell it so far up past where the fundamentals could have gone. And just look at this on the vice versa, right? The bullish high before this drop, 1-14-26, that was whenever people were most bullish. So no one was looking in the rear view mirror. They weren't looking at the sides. They were straight ahead, nothing around them. They were oblivious, right? So, and that caught a lot of people off guard because a lot of people were pretty bullish and weren't understanding this. So me, how do I read these charts, right? This is me. Like, this is how the markets kept going up. I like to see, hey, is it more bearish than the historical average? Is it less bullish? Or is like the spread? I look at the bullish to bearish spread more. So I look at, hey, 6.5% more bullish and bearish, which makes sense. The market goes up more. 30.1, great. I think the market's going up here. Right here, it's turning over a little bit bullish, maybe just a little bit cool down. But still, I think the market's going to go up more because usually whenever you see the spreads like really change, it's almost more so like whenever you see one that's like plus 20% bullish, minus 20% bearish or something around there, that's whenever you're really, really getting the tops. Because something like this means hey, the market's probably just going to keep going in the same direction. And then the next thing you can go look at, right, is what happened? Well, it started flipping bearish and bearish again. And sometimes on these, it's like if it's super, super bullish for a while and stuff starts finally flipping bearish, then you're like, okay, the crash might be coming because people are positioning a little bit. Maybe they know. But whenever it's just, it hasn't been super, it just finally, this was like the bullish as it's been in a while. People came out and now they're worried. Why? Because yields are flying. They're worried about inflation. They're worried about Iran still. Is Trump lying or not? And look how bearish people are. This means a lot of people are probably buying puts. A lot of people are selling stocks. A lot of people are doing stuff that they don't believe in the market right now. Which gives me the idea that even if we get a rate cut, it's so baked into the prices, the market's still going to go up. This other thing that I like to look at, right? The net assets under management by institutions. So look at this. They were pretty, so a number right here, 0, means there's no assets in. Less than 0 means institutions are like leveraged, they're short. And up to 100 means they're all in. Over 100 means they're leveraged long. So look at like tops around the market. Anything you see around 100 is kind of worrisome. Even May 6th, like that's nice that we see this. Oh wow, it's pulled down all the way to 77. What does that mean? There's a lot of cash on the sidelines to go the market up. And just like look at what this does, right? So April 1st-ish, 26th, March 25th, like March 18th was the lowest. So like this, they actually started buying up. The institutions bought the dip here. Retail got killed on this. Retail was the one who got destroyed. Last year, the institutions didn't do as good. Look at April 16th, and they're still going down, right? The market, I don't know why it says April 16th. The market bottomed around the first early April last year. So maybe it just was off a little bit. But basically, look at this. Whenever you got a high name, look at these highs. What happened in October, right? We had a little pullback into November. And then market peaks around in January. And that's where you get like some of these highs. So these are just some, like a lot of these are great contrarian indicators to look at. How are people positioned in the market? Are they positioned as bullish or as bearish as they are as normal? If they're way more bearish than normal, there's a good shot you can get that market moving up. If they're positioned way more bullish, then, well, the market has a lot of time to stop possibly going and get down. So that's just how I look at it. And now the part you've been waiting for. What's the stock that we bought? e.l.f. Beauty, right? Look at what they just put up the other day. Quarter 4, they just beat on EPS by 9%, and they beat on revenue by 6%. And this, right, for them, is supposed to be a quarter that they were not supposed to do that good in. Their CEO even said, hey, we might be having some problems. So this is just, this beat was a big shock. And look how much they beat in the past. And you know what they did? They went and they revised down their 4-year guidance, which it's okay because they always beat it by so much that if you're like, okay, if they guide for something, they're going to guide, they're going to beat Wall Street. Like if you look at this, look at these beats here on EPS and revenue. Look at this, 71%, 19%, 8.2. Like they're beating here by just unreal numbers. And say they can beat on average, right, by like 10% Wall Street. After we get into this, just look at what they can. They just have to beat by 10%. Nothing crazy. If they just beat by a little bit, we're going to show you their share price, what they could be going to this year and in the future. But let's just go and read through some of the stuff that they did. What they did a lot this quarter was actually they went and they slashed a bunch of their prices. And what did this lead to? It led to way more people buying in revenue. Because why did last year did they push those prices up? Because they thought there's going to be tariffs. So they're like, okay, crap, we're going to get tariffed. We're going to be paying so much more to make these products. And now we're going to have to make prices spike. Now, whenever you take the prices down, boom. Next thing you know, people are like, okay, e.l.f., let's go buy it. It's way more cheaper. And look at these revenue, 40% extra. That revenue translates to EPS. So that's just something the company's been doing. But basically what they did is Rode, Haley Bieber's brand. That's just a huge thing. That's taken over for them. And another huge thing about the company is a lot of these other companies, they do 70% of their sales in the international market. This is like Celsius, the thesis, right? They're only doing 20% of their sales internationally right now. There is a huge, huge market they're not even tapped into. So imagine what they could do. If they could just, they would 3x their revenue if they got up to that 70% internationally. And a lot of their subscribers and everyone's outside the US. And that's what they're starting to do, invest and get all these brands into companies in other countries, into the stores. Their core e.l.f. brand is, they basically did a Celsius, right? They acquired Rode to get the growth back. That's what you got to do sometimes. You make a good acquisition, it grows, and makes your company so much more profitable and get someone in the future. Their gross margins flew up, which is great. And because they called for slower sales, basically, they're saying that organic sales are going to be a little bit slower, but then it's going to start getting higher. And because there's a heavy shipping period, it's not an e.l.f. problem, it's just shipping. So basically what they're doing is they're trying to go and build up the brand and diversify and spend money to get the products in the stores worldwide to get these global sales going, right? And still, Rode delivers and exceeded expectations. The brand achieved the #1 beauty ranking in Sephora in North America and launches internationally, like I've been saying. So basically, that's pretty impressive that Hailey Bieber and this acquisition is going to do that for the company. And let's just go and take a look at their numbers going forward, because e.l.f.'s also just a company that you want to be in, right? Say we do some inflationary or something going on. What are women going to do? What is your girlfriend going to do? If you're a woman watching this, what are you going to do? You always need makeup. You always need lip gloss. You always need everything for going out. You're buying that no matter the market. And why is e.l.f. actually even better positioned if this happens? Because they're a lot cheaper of a brand. So maybe people, instead of buying Estee Lauder, which we think e.l.f.'s going to get to their level like that eventually, they're going to say, okay, let me go buy e.l.f. for way cheaper, and it's still very, very good quality products. So that's what people are going to do. It's like, you need this. It's almost like a necessity for women, even though it's not a staple. People are still going to buy this. And if you price it down, well, everyone has more spending problems. They're going to go buy more of your product over these other brands and allow you to take market share. For whenever the market gets great, you're going to have a bigger market share and go into the future. So that's just what you have to think about this, right? So this is what we have for e.l.f. We literally have them just doing a little bit better than analysts, not much. And you've seen they beat by 10%. So realistically, we have that in our bull case. And we're going to show you our bull case to where they could be over the next year. Mind you, this is over like the next 4. This is pretty crazy compounding annual growth rate for this company, right? So say they do 17% revenue growth, 17%, 16%, 16%. And they're probably they're 1.8 to 1.9 revenue, which they're sandbagging, right? You just go and look at this. They're literally beating out here by pretty good amount of whatever. So if say they just beat this by 5%, right? So say they're going to do 1.9 billion, just 5%. They could easily be doing 2. Just think of that this year for what they could possibly be doing, right? Just saying for this company. Because and that's not even insane. Like we have like these numbers crazy for a bull case. 70%, 16%, 16%. Their margins just get a little bit better over the years. I don't know why this is 0.44. That's just weird. But basically you get up to 22% just net income growth over the next few years, which, right, that's fine. You're expanding those margins. And basically they're buying back only 1% of shares, which they might even be buying back more. They're trading at a forward peg of just 1.2, just a 30 to 35 for a company growing like this, double digits, expanding margins. 30 to 35 is very fair for a company like this. They're forward. You know what they're trading at a forward peg ratio, PE ratio of right now? 15.24. Their real forward peg's like 0.60, but they're trading at a forward PE of 15.24. Which, compared to our numbers, which is right around analysts, and they're going to be growing at double digits for revenue and net income for the next foreseeable years. Just how cheap is a stock like that? We have them going to $113 share price by the end of the year. Remember, this stock was almost $140, $150 stock just 6-7 months ago. Then they go up to $180.38 and getting a CAGR of 40% over the next 4 years. With this stock, could literally hit $100 this year. Easy. Just the market turns around better. People are around the consumer. They show that, hey, we're going to guide up. Maybe something different with like the actual e.l.f. brand, and Roche is not this one-off. Their international expansion. Boom, you're there. Let's take you through our bear case. Our bear case, we still have them getting to $90 this year in our bear case. This is just them doing an EPS of 3.08, way worse than us, growing revenue at 14, net income at 235. And basically, you can probably say, okay, let's just change this down to like 2025, just to be fair. Okay, but still, right here, $70 a share, 30% increase from right here. And over the next few years, getting into a 17% CAGR, which you could argue and say, okay, hey, are these P's high? Like, maybe. Is this more fair for a company growing like that? Yeah, you could say that. So let's just say we're using Fort Gamma right here. So let's just say they do this, right? Still getting a 10% CAGR at the low point. That's pretty good over the next few years for a company that we've seen how much they beat, where they're in a sector that people are going to keep buying their products. And then our bull case, they're not even getting to that $2 billion, so they just don't even beat by that crazy what their numbers are going to be. 21%, 19, 19, 19, so they stay up, they stay growing, international expansion. They're only getting up to an EPS at 3.67 this year. They're trading at a 40 to 50 P, which for what they did and what they're going to do in the next few years is pretty fair. Buying back a little shares, they get to $165 this year and $350 over the next 4 years. This is like a 7x from these prices right now for a makeup brand that people are going to have to go to. So thank you guys for watching. Like and subscribe and leave some comments if you guys have any about any new stocks.